Hi guys, and welcome back to another Smart Tips video with me, Connor. Today I'm going to be talking about which instruments correlate with one another and why. So firstly, the intermarket correlations. There is many intermarket correlations as trades we have to remember between forex pairs such as the pound dollar or the euro dollar, stocks such as Apple or Amazon, indices such as the FTSE 100, which is the top companies within the UK, or even the Dow Jones, which is the top companies within the US, and also commodities such as gold or silver. As we know, gold heavily affects a lot of the pairs within the FX markets. Within the price action of these instruments, there is often huge volatility because of their relationship with commodities, bonds and stock indices. Today we're going to be going through a number of examples of the intermarket correlations. However, there are many more that we have to be aware of. It is important that you familiarise yourself with the correlations and research the other ones that there are in the market. So firstly, we're going to start off with gold correlations. There is a number of these, and it's important to note these as gold heavily influences the FX markets. So firstly, starting off with the price of gold against the US dollar, or the pair as we know, XAU-USD. If the price of gold increases, the price of the US dollar decreases. This means there is a negative correlation. As one goes down, the other one also goes down. This is because when there is economic unrest, investors tend to sell the US dollar and go to the safe havens, which could be gold or the Japanese yen, particularly gold as it holds its intrinsic value well. If the price of gold increases, then this causes the price of the USD CHF or US Swiss currency pair to decrease. This means they have a negative correlation. As one goes down, the other one goes down. This relationship is because the 25% of the Swiss franc reserves are within gold. Therefore, the currency's value increases with gold against other currencies. Moving on to the Australian dollar US dollar pair. If the price of gold increases, the price of the Australian dollar US dollar increases as well. Therefore, there is a positive correlation because as one goes up, the other one also goes up. The reason for this is because Australia is the world's third biggest gold producer. Another currency that is very close to Australian dollar and therefore very well correlated, which is the New Zealand dollar or Kiwi. As we know, Australian dollar and the New Zealand dollar pairs move very similarly, and we can also notice that with gold. So moving on to the New Zealand dollar US dollar pair. If the price of gold increases, no surprise, the price of the New Zealand dollar against the US dollar increases as well. Therefore, there is a positive correlation, just as we saw with the AUD-USD pairing. The reason for this is because New Zealand is also a large provider of gold. If the price of gold increases, then the price of the USD CAD decreases. As we know, USD CAD is very influenced by oil, but it's also influenced by gold. Therefore, we know there is a negative correlation between gold and the USD CAD. As one goes up, the other one goes down. This is because Canada is the 5th largest producer of gold within the world, and therefore, when gold increases, the CAD gains strength. Next, we have the euro-dollar pairing. If the price of gold increases, then the price of the euro-dollar pair will also increase. Therefore, they have a positive correlation because as one goes up, the other one goes up. This is because the euro and the gold are seen to be anti-dollar pairs, which means when people are looking to sell the dollar, they typically turn to the euro or the gold, and that's why we see very much volatility and liquidity between the euro dollar pairs and the gold dollar pairs. Now moving on to that pair we spoke about before, oil and USD CAD. If the price of oil increases, the price of USD CAD decreases. The important thing to note here is that although USD is the base in the pair of the USD CAD, oil affects CAD on its own, and therefore we have to look at how the oil will affect the CAD and how this pair will move in terms of that. So as we know, they have a negative correlation, so as the price of oil increases, CAD increases, and therefore the USD CAD pairing decreases as USD CAD is the base pair. This is because Canada is the 4th largest oil producer, and oil is the largest single contributor of foreign exchange to Canada, and therefore their biggest export. Therefore, most of the money coming into Canada from other countries is due to the payments for oil, and therefore as oil increases, the price of the CAD increases. Now moving on to the indice correlation. So as we spoke about before, the Dow, which is the US indices, or also the Nikkei, which is the Japanese indices. So the correlation between these two is that when the Dow decreases, the Nikkei will also decrease. Therefore, they have a negative correlation. This is because the performance of the US economy is closely linked with Japan, and therefore we can see USD JPY acting in a very similar way. So now we can actually go over to the MyFXbook currency correlation calculator. This is a very useful tool, and I'm going to teach you how to use it today. So now I'll move over to MyFXbook. Okay guys, now just move over to the MyFXbook currency correlation calculator. So you can see in Google, if you just search this, we've got the MyFXbook at the top, and then we can see we will have our calculator load up below. So I filtered this myself using the More feature, where you can just change it to the main pairs that you use. So you could be different currency pairs, different indices such as the NAS, which is the US, or even some commodities such as gold. So now what we're going to do is we're just going to look at a couple of different pairings just to see how the correlation is. So for example, if we start off with the Australian dollar CAD, obviously the Australian dollar is the base currency here, so if we look at another pair with the base dollar of the Australian dollar, we have a 93.7% correlation between the Australian dollar CAD and the Australian dollar yen. We'd expect this as the Australian dollar is the base currency here, and therefore we see a very strong positive correlation. However, what happens if we look at a USD based pairing such as USD CAD? Well, if we look at USD CAD versus USD JPY, we can see the USD CAD here. So we can say that the Australian dollar CAD as before, we have minus 83.2%, so very negative correlation. However, if we go to the dollar yen, we can actually see it's a minus 76.1% correlation, which is strange because these are both US dollar pairs. Well, in fact, due to different things such as commodities or indices, we can actually see that there's a minus 76.1% correlation, meaning there's a very strong negative correlation. And therefore, we can actually note how both of these dollar pairs actually move in different ways, although the dollar may be the significant pairing or the base pairing here. And that's something we need to consider. Just because you might have a buy on $1 pair, you might also be able to have a sell on another dollar pair, and they both could go into profit. However, we can use this calculator as a tool, just as a general rule of checking different correlations between these pairs. So when we go into a trade, if we have full confidence in one trade and then full confidence in another high probability setup, we can use this correlation to check the correlation between these pairs and check whether we have the right idea in trading both pairs. It's a very useful tool, and you can customize it to any pairs or commodities you use, and I hope this is helpful for you in the future, and I'll see you guys in the next video.